Imagine walking into a bank to apply for a mortgage. Within seconds, a number helps determine whether you'll be approved, how much you can borrow, and even the interest rate you'll pay. Most people know that number as a credit score. But very few know the company behind it. That company is FICO. For decades, lenders have trusted FICO to evaluate risk, making it one of the most influential businesses in global finance. Yet unlike the world's biggest technology companies, FICO rarely makes headlines. It doesn't build smartphones, manufacture chips, or dominate social media. Instead, it quietly powers billions of lending decisions behind the scenes. So here's the question every long-term investor should ask. How do you compete with a business that has become the standard everyone already trusts? Today, we'll explore why FICO may possess one of the strongest economic moats in the financial industry, and why replacing it is far more difficult than most investors realize. Most investors know FICO for one product, the FICO Score. But that's only part of the story. Today, FICO operates through two complementary businesses. The first is Scores, where it licenses credit scoring models to banks, mortgage lenders, and credit card issuers. These models are deeply embedded in lending decisions, creating recurring, high-margin revenue. The second is Software, which helps organizations automate decisions, detect fraud, manage risk, and improve customer engagement. Its platforms are used across banking, insurance, healthcare, and other industries where accurate decisions matter. Together, these businesses make FICO much more than a credit scoring company. It has become a critical decision platform embedded in customers' daily operations. Understanding that distinction is essential, because it explains why replacing FICO is far more difficult than most investors realize. One of the strongest signs of a durable competitive advantage is customer retention. In FICO's case, customers rarely switch. The reason goes beyond software. FICO's scoring models are deeply integrated into underwriting systems, risk management, and regulatory processes. Replacing them means rebuilding critical workflows that affect every lending decision. For a bank, the potential savings from switching are often small compared with the risks. A new model could change approval rates, increase credit losses, or create unexpected compliance challenges. More importantly, FICO has earned something that competitors cannot easily replicate: trust. Its models have been tested across multiple economic cycles and are widely accepted throughout the financial system. When a product becomes the industry's trusted standard, customers don't stay because they're locked in. They stay because leaving creates more uncertainty than value. FICO doesn't dominate because it is the only credit scoring company. It dominates because it has become the industry's reference standard. Banks, mortgage lenders, investors, and financial institutions have built their lending processes around FICO scores for decades. When every participant relies on the same benchmark, changing that benchmark becomes extremely difficult. This creates a powerful competitive advantage. The more lenders adopt FICO, the more borrowers are evaluated using its scores. As confidence in the standard grows, more institutions continue to rely on it, reinforcing the entire ecosystem. Competitors can develop alternative models, but convincing thousands of financial institutions to abandon a trusted standard is a very different challenge. That's why FICO's moat extends beyond technology. Its real advantage lies in industry-wide acceptance. Once a company becomes the benchmark, replacing it requires changing the behavior of an entire ecosystem, not just winning a customer. Pricing power is one of the clearest indicators of an exceptional business, and FICO has demonstrated it consistently over time. The reason is straightforward. For a lender, the cost of using FICO is insignificant compared with the cost of making a poor lending decision. If a more accurate model helps reduce credit losses, a higher licensing fee becomes a small price to pay. That dynamic gives FICO unusual flexibility. As pricing increases, much of the additional revenue flows directly to profit because software requires very little incremental cost to scale. The result is a business with expanding margins, strong cash generation, and attractive returns on capital. Companies with real pricing power don't compete by being cheaper. They compete by being indispensable. And when customers view your product as essential rather than optional, raising prices becomes far easier than replacing the provider. Artificial intelligence is transforming financial services, leading some investors to wonder whether it could replace FICO. It's a fair question, but it overlooks what customers are really buying. Banks don't simply need the smartest algorithm. They need decisions that are consistent, explainable, and trusted by regulators, investors, and risk managers. In lending, credibility is just as important as predictive accuracy. That is where FICO holds a meaningful advantage. Its models have been refined through decades of real-world lending data and multiple economic cycles. More importantly, they are already embedded within the industry's decision-making process. Rather than competing against AI, FICO is using AI to strengthen its own software platforms, helping customers make faster and better decisions. Technology will continue to evolve. But as long as trust remains the foundation of credit, AI is more likely to enhance FICO's competitive position than replace it. A durable competitive advantage should eventually appear in the financial statements. In FICO's case, it does. Over the years, the company has delivered consistent revenue growth while expanding earnings at an even faster pace. That reflects the economics of a software business, where incremental revenue carries very little additional cost. FICO also generates strong free cash flow, giving management the flexibility to reinvest in innovation, repurchase shares, and create long-term shareholder value. Equally important, the business requires relatively little capital to grow, supporting high returns on invested capital. These metrics are not isolated strengths. They reinforce one another. A sticky customer base supports pricing power expands margins, and higher margins produce stronger cash flow. For long-term investors, the financials confirm what the business model already suggests. FICO isn't just a quality company, it is a business built to compound value over time. Generating cash is only half the story. The other half is how management allocates it. FICO has consistently demonstrated disciplined capital allocation. Rather than pursuing large acquisitions or capital-intensive expansion, the company focuses on investing in its core business while returning excess cash to shareholders through share repurchases. This approach can be highly effective. As the share count declines, each remaining shareholder owns a larger portion of the business. When combined with growing earnings, that can drive even faster growth in earnings per share over time. Equally important, FICO doesn't need massive capital spending to expand. Its software-based business model allows a significant portion of operating cash flow to remain available for reinvestment or shareholder returns. A great business creates cash. A great management team allocates it wisely. FICO has consistently demonstrated both, and that's one reason its long-term compounding story remains intact. One reason investors overlook FICO is its valuation. The stock has rarely looked cheap using traditional metrics, leading many to assume that most of the upside has already been priced in. But that view can be misleading. The market often focuses on today's earnings multiple, while long-term investors focus on the durability of future cash flows. For businesses with exceptional pricing power, high returns on capital, and disciplined capital allocation, intrinsic value can grow faster than many investors expect. FICO is also easy to misunderstand. It doesn't launch breakthrough consumer products or dominate headlines. Instead, it quietly compounds value through recurring revenue and mission-critical software embedded deep inside the financial system. History shows that outstanding businesses often appear expensive before delivering years of superior performance. The real question isn't whether FICO trades at a premium today. It's whether the market fully appreciates the quality of the business behind that premium. The best compounders don't need to reinvent themselves every few years. They simply expand the value they already create. FICO fits that description. As lending becomes more digital, financial institutions need faster and more intelligent decisions. At the same time, fraud is becoming more sophisticated, regulatory requirements continue to evolve, and customers expect instant approvals. These trends increase the demand for advanced decision analytics. FICO is well positioned to benefit because its software already sits at the center of many of these workflows. Beyond traditional credit scoring, the company continues expanding its decision platforms, fraud solutions, and AI-powered analytics across financial services and other industries. The opportunity isn't about entering entirely new markets. It's about solving more decisions for existing customers. For long-term investors, that's an attractive growth model: deepen customer relationships, expand product adoption, and let recurring revenue compound over time. No investment is without risk, and FICO is no exception. The first is valuation risk. High-quality businesses often trade at premium multiples, leaving little room for disappointment if growth slows. Second, lending activity is cyclical. During economic downturns, lower mortgage originations and reduced consumer borrowing can temporarily pressure transaction volumes, particularly within the scores business. Third, competition continues to evolve. Alternative credit models and AI-driven analytics are improving, even if replacing FICO's position remains a difficult task. Finally, regulatory changes could reshape how creditworthiness is measured, requiring FICO to adapt its products over time. None of these risks necessarily weaken the long-term investment case. But they remind investors that even exceptional businesses face uncertainty. The key question is whether these risks are temporary challenges, or structural threats to FICO's competitive advantage. By now, the investment case is clear. FICO has a durable moat, strong pricing power, excellent capital allocation, and a long runway for growth. But owning a great business only creates superior returns if you pay a reasonable price. That's why valuation matters. Even the best companies can become poor investments when expectations are too optimistic. Conversely, periods of market pessimism often allow investors to buy exceptional businesses at attractive prices. Rather than relying on a single price target, I prefer a three-scenario framework. It recognizes that valuation is driven not only by fundamentals but also by market psychology. Investors move through fear, normal expectations, and optimism, and valuation moves with them. Let's examine where FICO could be worth under those three scenarios, and whether today's market price reflects opportunity or excessive optimism. Now let's turn to valuation. Before looking at the numbers, I'd like to share one principle that has guided my investment process for many years. Valuation reflects both fundamentals and market psychology. Fundamentals determine what a business is worth, while market psychology determines what investors are willing to pay at different points in time. That's why I don't rely on a single fair value estimate. Instead, I use three scenarios to reflect different market environments. The conservative value of $795 assumes a more cautious market with lower valuation multiples. The base case value of $1,496 represents my estimate under normalized assumptions and serves as the reference point for intrinsic value. Finally, the optimistic value of $2,398 assumes the market continues assigning a premium to FICO's exceptional business quality. These scenarios are not predictions. They simply provide a disciplined framework for evaluating valuation under different market conditions. Markets are generally efficient, but they don't always price businesses correctly. Sometimes, investors focus too much on valuation multiples and not enough on the quality of the business behind those numbers. That may be the case with FICO. Many investors still view FICO as a mature credit scoring company. But today's business is far more than that. It combines a trusted industry standard with mission-critical software, recurring revenue, exceptional pricing power, and disciplined capital allocation. These qualities don't always produce the fastest revenue growth, but they often create something more valuable, durable compounding over many years. If FICO continues strengthening its competitive position while expanding earnings and free cash flow, its intrinsic value can continue growing, even during periods when market sentiment fluctuates. Ultimately, the biggest question isn't whether FICO can survive. It's whether the market fully appreciates the long-term value of a business that has become increasingly difficult to replace. As we conclude, one thing becomes clear. FICO's competitive advantage isn't built on a single product or a single technology. It's built on decades of trust, deep customer integration, and an industry standard that has become increasingly difficult to replicate. The company combines recurring revenue, strong pricing power, high returns on capital, and disciplined capital allocation, qualities that have historically defined many exceptional long-term compounders. Of course, every investment carries risks. Competition evolves, regulations change, and market sentiment can shift. But none of those factors automatically weaken a business with a durable competitive foundation. For long-term investors, the most important question isn't whether FICO will face challenges. Every great company does. The real question is whether another company can realistically replace the trust, the ecosystem, and the market position that FICO has built over decades. So perhaps the better question was never whether FICO is expensive. It's why nobody has been able to replace FICO. As always, this video is not financial advice. Please do your own research before making any investment decisions. Thank you for watching. If you found this analysis helpful, don't forget to like, subscribe, and I'll see you in the next equity research.